So it's tax time, and you're probably working on your personal income tax returns for federal and for state purposes. And if you decide to prepare your own tax returns, I want to make you aware of my top 5 red flags for a potential IRS audit. If you haven't been through an IRS audit before, it's not a fun experience, it's not your fault, but there are actions you can take now to be aware of to limit your risk of being selected for an audit. And so here are my top 5 that I've seen through my career most often that are possible triggers. So the first one is not reporting all of your income. If you didn't know this, whether it's on a W-2 or a 1099, the income that you've earned through the year, either from your employer or maybe interest on a savings account, you get the 1099, but guess what? So does the IRS. So as an example, your bank, let's say you have a savings account, you have some money saved, and you've earned a little bit of interest throughout the year. You get a copy of your 1099 with your amount of interest, but guess what? The IRS gets a copy too. So if you forget to include that amount on your personal tax return, or it comes in after you've filed it, the IRS is going to know, and in their software, they actually match up the amounts to see possible amounts excluded from your income, and that's a red flag. The second one I've seen a lot is reporting 100% business use of your car. Let's say you have a small clothing shop and you in fact do use your car for business purposes, but you report 100% usage. Well, guess what? That's not going to fly. Most IRS auditors are going to say that there's no way you used your personal vehicle exclusively for business reasons. For example, if you use it to get to and from work, maybe to make some deliveries, well, what about the weekend? What about time with your family? And they're going to challenge that position, so you do need to think about what percentage of your usage is for personal use and take that deduction down a bit just to be safe. The next red flag, the third one, is unusually large charitable donations. And did you know that the IRS actually analyzes the amount of charitable deductions based on income level? And they have an expectation based on how much income you report of what your charitable deductions are going to be? Well, they do. And when you're outside of that expectation, you're on their radar. And again, this is a red flag you're trying to avoid. We've all taken our maybe excess clothes, our kids' clothes to Salvation Army and Goodwill, and you get handed a blank piece of paper, and it's at your discretion to write what you've donated. And you think about it as you get ready for your taxes, and you think, that was a Louis Vuitton purse, maybe some Jimmy Choo shoes from your wife. And in fact, guess what? That bag of clothes is now valued at $2,000. Be careful here. You don't want to get too aggressive because the IRS does have a predictive model. And if you go beyond what an average amount for your income level is, you could be on their radar, and that is a red flag for an audit. The next one, this is what's going to be on a Schedule C. If you don't know what that is, on your personal tax return, if you have a business, let's say you have a small restaurant, you can report that on a Schedule C. That means you have your own business, you're self-employed. And that is also where some people take advantage of reporting what's called a hobby loss. Let's say maybe you like making wine. You get grapes from somewhere. I live in California, and you take them home, you make wine in your backyard or in your garage, and you report those losses or those expenses to reduce your taxable income. Well, guess what? You can only report a Schedule C or a business if there's a reasonable expectation of a profit. So if every year you're reporting expenses for your winemaking business and you never make money, that is a red flag. So be careful with what you claim on a Schedule C as a business owner, as a sole proprietor, because if you never make money, they're going to challenge that. And the last red flag, number 5, is also on your Schedule C if you have a business, and this is excessive meals and entertainment or travel. Let's go back to the example of you have a small clothing store. I know we can all have valid travel. You're driving to potential places to sell your goods, or you could be going places to see where you can get distribution. But you could also maybe put through too much. Maybe that trip to Europe that you're thinking, I talked to somebody over there about clothes, and therefore I can write off the whole trip. And this is one of the first places that an IRS auditor will look, because this is one of the most common mistakes that people make and expenses they try to take advantage of. And I've seen it more times than I can count. So just be careful with reporting too much meals, entertainment, or possibly travel on your personal income tax return. So those are my top 5 red flags for a possible IRS audit. Be careful with those, but do claim any legitimate expenses. If they are unusually large but are valid, just make sure you've got good records, so if you do get picked one day for an audit, that you can substantiate that with your receipts, travel logs, whatever it is. Well, I hope you find this useful, and I look forward to talking to you in my next video.